Welcome back to the Deep Dive, customized just for you. Today, we're diving into a real giant of the Indian corporate scene, Coal India Limited.
That's right, CIL, a Maharatna company, which carries a lot of weight, strategic importance, high governance standards, theoretically.
And we've got their latest numbers, the unaudited consolidated financial results and physical performance. This is for the half year and the second quarter ending September 30, 2025.
Yeah. And our mission today is really to get under the hood of these results.
Because the big headline is, well, it's not great. A 25% drop in profit after tax. That sounds pretty bad.
It does. It definitely catches the eye. But just looking at that number, it doesn't tell you the whole story. Not even close.
Exactly. We need to go deeper, look past that immediate P&L hit and figure out what's really going on. Strategic shifts, maybe some one-off costs?
Precisely. What are the structural forces shaping CIL right now? I mean, this is a massive company trying to navigate a huge energy transition.
And change, especially for a company this size, well, it often comes with a hefty price tag, doesn't it?
It certainly can. If you look at the bigger picture, CIL seems to be actively trying to de-risk its future. They know the world is changing.
So they can't just be a coal company anymore.
They're trying not to be. It looks like they're building towards maybe 3 distinct pillars for revenue going forward.
Okay, 3 pillars. Interesting. Let's unpack those. What's the actual evidence? Are they really diversifying into, future-proof areas?
Well, the moves seem pretty significant. First off, critical minerals. They're making a real play there.
Critical minerals. Okay, how so?
Back on June 30th, 2025, they signed an MOU that's a Memorandum of Understanding with Hindustan Copper Limited.
Right.
The goal is collaboration, working together on copper, obviously, but also other critical minerals. Think batteries, high-tech manufacturing, that kind of stuff.
So a definite step away from just digging up thermal coal. What about green energy, renewables? They have to be in that space.
Oh, they are.
Yeah.
And they seem to be pushing hard. There's another MOU, this one signed in May 2025 with UPRVUNL. That's the state power company in Uttar Pradesh.
And what's that for?
A big solar project, 500 megawatts. That's substantial.
Wow, okay.
And they're not just signing deals. They actually set up a whole new subsidiary back in June. CL Rajasthan Akshay Urja Limited.
A dedicated solar subsidiary.
Seems like it. CIL holds the majority stake, 74%. So they're putting serious structure and capital behind this solar push.
So new green ventures, and are they expanding their traditional mining but into different minerals?
Yes, exactly. We saw them win a bid. They became the preferred bidder for a block in Chhattisgarh, the Auranga Ravatapur graphite and vanadium block.
Graphite and vanadium. Again, battery components, right? High-performance stuff.
Precisely. And then there's the third piece, which is maybe less about new ventures and more about existing ones maturing.
Okay.
Their joint ventures. They actually received their very first dividend from one of them, HURLL, Hindustan Urvarak, and Rasayan Limited.
Ah, the fertilizer JV. How much was it?
About 404 crore. Now look, in the grand scheme of CIL's total revenue, that's not huge.
Right, relatively small.
But getting that first dividend check, it signals that those long-term JV investments are starting to pay off. They're becoming profitable assets.
Okay, so a clear picture is emerging. They're buying into critical minerals, building green energy capacity, and starting to see returns from earlier JVs. The future strategy looks diverse.
It does. But, and this is the crucial but for these results.
The core business, coal mining.
Yeah, the engine room. Its physical performance was actually a bit softer this half compared to last year. Now, last year was a record, remember?
True. So how much softer?
Overall coal production, down 4%. Offtake, the amount actually sold and shipped, that was down 3%.
Right.
And even OB removal, the overburden they have to clear to get to the coal, that was also down 3%.
So those numbers suggest maybe the core coal demand is, stabilizing or easing off slightly.
Could be. But here's a really interesting positive point on the operational side. Inventory.
Ah, yes, the stockpile. What happened there?
They had a massive success in clearing out old stock, a huge logistical win, really.
How much did they reduce it by?
Their closing inventory at the end of September was down to about 79 million tons. Compared to the start of the financial year, that's a 27% reduction.
27%? That's huge. Frees up a lot of capital and space, I imagine.
Absolutely. Though it's worth noting, where that stock is concentrated. MCL and SECL, two big subsidiaries, still hold the lion's share.
Right, Mahanadi and Southeastern Coalfields. Okay. And just quickly, most of the actual digging and hauling is outsourced, isn't it?
Heavily. Contractual operations accounted for 65% of the coal produced and a massive 87% of the overburden removed. This is very much an externalized model.
Okay, so physical slightly down, inventory managed well. Now we have to tackle the financials. Because a 3% dip in offtake doesn't usually lead to a 25% profit crash.
Exactly. That's the paradox, isn't it? Consolidated net sales fell 3%, which kind of lines up with the physicals.
Right.
But profit before tax, PBT, just plummeted, down 20%.
And profit after tax, PAT, even worse, down 25%.
So the big question is, sales dip slightly, profits fall off a cliff. Why?
What's the answer?
It seems to be a double whammy. First, the price they got for their coal, or the realization rates dropped. And second, costs went up, partly due to strategic spending and one very large hit.
Okay, let's take realization first. Where did the prices fall most?
Particularly in the high-margin segments. E-auction coal, where they get market prices, the average realization fell.
From about 2,428 per ton down to...
Down to 2,315. A noticeable drop.
Okay.
But the real pain was in wash coal. That's their premium stuff.
And the realization there?
Fell off steeply. From over 3,860 per ton down to just under 3,400.
Ouch. So when you get less money for your best products, even a small volume drop hurts the bottom line much more.
Precisely. It compresses the profit margins significantly.
Okay, that's the revenue side. Now the cost, you mentioned a big hit. This is where it gets really interesting, I think.
It is, because the cost side absorbed this huge, basically non-recurring charge that just hammered the P&L for this period.
Oh, was it?
The biggest percentage jump in expenses was under depreciation, amortization, and impairment. That line item soared 29%.
29%. How much in actual money?
Over 1,100 crore increase. And the main driver, the overwhelming reason for that jump,
Yes.
was a massive one-time write-off, an impairment charge of 553 crore.
500 million rupees, just like that. Impairment of what?
Exploration and evaluation assets. Basically, potential future coal blocks.
Why were they impaired? What happened?
It was a regulatory decision. 21 coal blocks located in the SECL subsidiaries area were suddenly declared to be under a safety zone.
Ah, so regulations changed and poof, assets that were on the books as valuable are suddenly considered worthless.
Essentially, yes, turned into a sunk cost overnight. That's not really a business operational failure. It's a direct consequence of a regulatory change. Wipes 500 million off the profit instantly.
Okay, that explains a huge chunk of the profit drop right there. Beyond that massive impairment, what else pushed costs up?
We see CIL spending more on, let's call it, governance and compliance-related areas, things that are necessary long-term investments, but hit the profit immediately.
Like what specifically?
Other expenses jumped 14%. That's almost 900 crore. And when you dig into that,
Yeah.
you see increases in environmental spending. Tree plantation costs up 202 crore. Higher CSR, corporate social responsibility spending, more on security. Plus, they got hit with a new state-level cess in Harkand.
So the cost of doing business responsibly and complying with local rules is going up.
It seems so. We also saw finance costs jump significantly by 32%. That's mainly interest on loans and some technical accounting stuff like unwinding of discounts.
Okay. And contractual expenses, since they outsource so much.
Up slightly, just 2%, mostly due to higher costs for outsourcing services, though offset a bit by lower transport costs. It just reinforces how reliant they are on contractors.
Were there any areas where costs went down?
Yes, one major positive trend on the cost side, employee benefits expense. That actually decreased by 2%.
How did they manage that?
Primarily through manpower reduction. Overall headcount was down 4% compared to the previous year. So CIL is definitely continuing its strategy of workforce rationalization. Fewer people means lower wage bills.
Got it. And if we look across the different CIL companies, the subsidiaries, is the profitability spread evenly?
Not at all. It's highly polarized. You've got two absolute powerhouses, NCL and MCL, Northern Coalfields and Mahanadi Coalfields.
They made most of the money.
Combined, they generated over 13,000 crore in profit before tax. They're the anchors. But then you look at the other end. Eastern Coalfields, ECL, posted a significant loss of 436 crore.
So the company's overall profit really depends heavily on just a couple of key regions.
Very much so. Okay, let's shift gears slightly. We need to talk about some critical regulatory items that the auditors specifically mentioned.
Right, the auditor's report. This often gives clues about governance and compliance.
Exactly. It's where we see if CIL is living up to that Maharatna status, at least according to SEBI rules, the market regulator.
Okay. First, though, any news for investors? Dividends.
Yes. Quick update there. CIL declared a second interim dividend, 10.25 per share.
Good to know. Now, the Big regulatory stuff.
The potential game changer flagged in the report relates to GST, goods and services tax.
What about it?
The rate on coal jumped from 5% up to 18%, effective late September 2025.
18%. That's a big hike. Why is that a game changer? Sounds like just a higher tax burden.
But here's the twist. CIL's management believes this higher rate will actually let them use a massive amount of accumulated input tax credit, or ITC.
ITC, that's like tax they've already paid on inputs, which they can normally offset against tax they collect on sales, right?
Exactly. It's essentially prepaid tax credit sitting on their books.
Yeah.
And because the output tax rate was so low before, they couldn't use it all up. It just kept accumulating.
So how much ITC are we talking about? How much is stuck there?
As of September 30th, a colossal 18,132 crore.
Whoa, over 18,000 crore. That's huge.
It is. And the thinking is, with the higher 18% GST rate on their output, they can finally start utilizing this massive credit balance. It potentially shifts a huge amount from a sort of locked asset or liability on the balance sheet into usable value.
That is staggering potential cash flow unlocked. Huge, however. The auditors didn't just talk about GST, did they? They flagged some issues.
They did. And these are, frankly, quite basic governance requirements for a company of CIL's stature. Non-compliance issues.
Sure, are they?
Two main things. First, CIL itself, the main holding company, hasn't met the SEBI rule that at least half its board directors must be independent.
Still, that's a long-standing requirement.
Apparently still not met. Second, two of its major subsidiaries, the big profit makers,
Yes.
SECL and MCL,
Yes.
they haven't complied with the requirement to appoint at least one woman director to their boards.
Wow. Okay, so fundamental governance gaps noted by the auditors at both the parent and key subsidiary level. That's surprising for a Maharatna.
It definitely raises questions.
So let's try and wrap this up for you, the listener. What's the takeaway here? The profit plunge looks bad, but it seems like a mix of factors.
Definitely. You had softer prices hitting revenue, especially on the high-margin coal. That hurt. But the expense side was arguably more dramatic.
Right, driven by that huge one-off impairment charge, the 553 crore write-off due to the regulatory change.
And also rising costs related to strategic shifts in environment, CSR, security, plus the finance costs. These are immediate hits, but some are arguably necessary long-term investment and just the cost of compliance.
So CIL is pushing hard into new areas, critical minerals, renewables, while simultaneously having to absorb these heavy, non-recurring costs and governance-related expenses in its main coal business.
That's the narrative, really. The profit drop wasn't primarily because coal sales collapsed. It was more about these expensive strategic adjustments, regulatory impacts like the impairment, and maybe slightly weaker pricing power.
Which leads us to our final thought for you to chew on. The auditors specifically flagged those two governance failures. Not enough independent directors on the main board, and no women directors at two key subsidiaries. Basic stuff.
Yeah, fundamental requirements.
Okay, so here's the question. CIL is potentially about to unlock access to over 18,000 crore in GST credits. That's a massive financial windfall. How quickly will that cash be used, not just for diversification, but to finally fix these basic governance and compliance issues that the auditors keep pointing out?
Will the financial flexibility mask the need for structural change, or will it fund it?
That's the tension, isn't it? Having the money versus meeting the standards expected of a company like Coal India? Something to watch.